Hey everyone, Jen Berbas with the Berbas Group in Austin, Texas, reviewing the real estate data from September with you. A little bit of a surprise with the number of pending contracts. We'll dive in right now. Number of pending contracts is up 9% from this month last year, which we didn't expect. In an election year, you expect it to be a little bit more depressed as far as activity goes. I think that's a direct result of the interest rates. Active number of listings is up 13% from last year. Really big increase. This is the highest level of inventory that we've had since 2013. Really quite a lot of inventory in the Austin market. People that are serious, sellers that are serious, absolutely can get sold. But it's not what we're telling our people. It's not a market for tourists. If you're a very serious seller, absolutely, it can get sold, but it needs to be priced correctly and prepared well. We're seeing pricing drop off a little bit this time of year. It's kind of normal. Usually at this time of year, people decide, well, if their house isn't sold by Halloween, then they're just going to pull it off the market and put it on next year. So we see a little bit of pricing decrease because only the people that really need to sell will sell in this time of year, or a little bit later, November. Pending, we talked about pending a little earlier. Pending units is up about 9% from last year. We didn't really expect this because an election year expected to be down. And this year started out a lot stronger. You can see that with this lighter line here. We thought this year was going to be better than last year. But because the Fed didn't lower interest rates, because the Fed didn't lower interest rates quite as quickly as the market had hoped, then buyer demand dropped off quite a bit. We think that it should be better next year. New listings by month. Inventory is at its highest level since 2013. And this kind of shows that what pace that level of inventory has been introduced to the market. This follows this normal seasonality curve. Usually we see a lot more houses come on the market February, March, April, and that drops off over the summer months. And then after Halloween, we don't really see much activity as far as new listings. This is a chart of interest rates. The Fed doesn't directly lower mortgage rates. The Fed telegraphs to the market what they're seeing, what their data is telling them, and then the market generates the interest for the mortgage rates. They don't directly set mortgage rates. And I think that's something that a lot of people don't understand. It's more of a derivative effect. The Fed, and so what was kind of interesting to me here, you see mortgage rates go up a little bit at the end there. So when the Fed came out and lowered 50 basis points last time they met, the market already had that baked into the mortgage rates. And so they didn't actually go down. You see this little bit sideways movement and a little bit ticking up. So you can watch the CME tool where the traders talk about where they think the Fed's going to put rates. And that's basically the 10-year traders talking about where they think rates are going to go. That's a really good indicator of whether rates are going to lower some more. And the mortgage market tends to follow those types of indicators rather than actually what the Fed does with the interest rates. Thanks so much for spending some time with us. If you have any questions, we're always happy to help, even if it's just some analysis or some questions about trades, remodeling, whatever it is that you guys need, give us a call. We're always happy to help.